So we're going to walk through a valuation in this video. I'm going to do Walmart. And to do a valuation, there's two things that we need up front. The most important things is we need a discount rate. We'll call that KE, cost of equity capital, and growth rates. Whoops. So we'll spend the first part doing the discount rate and the second part getting the growth rate. To get the discount rate, well, obviously we're going to use the capital asset pricing model. That's a good model to use compared to any other that we could use. There are obviously some other ones out there, but this is a good one to use. And to do that, we need a few things. We need a risk-free rate. We need a market risk premium. And we need a beta. So those are the three numbers we need to get a discount rate. So let's start with the risk-free rate. To get the discount rate for this firm, we need a risk-free rate. There's three approaches. You know, traditionally, you just use the current 10-year Treasury yield. You can get that from Yahoo Finance or from several places. It's a very easy number to get. But if you do that, you can do that. You can just pull that number. So let's go pull that number from the internet. So we'll go to Yahoo Finance and you just click up here at the top and go over to the right until you find the 10-year Treasury, and there it is, 0.778 or whatever it is for the day that you're doing this. So you can type it as 0.778%. Make sure it's less than 1%. Don't make sure it's not 7.8% or 78%. Make sure you have that typed in correctly. So there's one approach, but here you must address it being so low. You have to say something about this. If you can use that approach, you can't just use the current Treasury and ignore the fact that we're at historically all-time lows. So Demodaren, I gave you an article link for Demodaren. You can certainly use that article link to go back and see what his arguments are. He may have updated that since he wrote that article, so you might get something more current from him. The last I checked, he's still using the current 10-year Treasury. He's not making any adjustments to it at all. But you at least have to address it, and you can put his words into your own words to do that. The second approach is what I used to use, and that is use a normalized 10-year Treasury. And here what you're going to do is you're going to do a nominal GDP minus some spread. And here what you can do is I've given you some charts. So the last chart is this one right here. So let's bring it over. We can use it in our discussion. So this just shows you historically. Now you'll be doing your paper in Word, not in Excel. So your paper, you have to write this out in words rather than just plug everything in Excel. You'll have to put it all in Excel, but once you got it all in Excel, you got to convert it into words into a paper. So that chart, what we show here is the purple is the 10-year Treasury yield, and the gold is nominal GDP growth. And you can see up until the late 70s, early 80s, GDP was about 2%. About 2% higher than the 10-year Treasury yield. These are decade averages so that you get rid of a lot of the noise. Obviously, they both went up a lot because these are nominal numbers, so inflation was high in the 70s. But something really changed in the early 80s, where GDP growth has been dwindling, partly because of inflation, but also just our economy is not growing as fast as it used to. The 10-year Treasury declined, but not by as much. And so we had a period there where the economy was actually lower than 10-year Treasury. It's now gone back to being higher. It almost has to with such a low number. So if you look at the historical number, You know, before the 80s, the 10-year Treasury should be about 2% lower than what you expect the economy to grow. So we'll have to get growth for the economy. We'll do that when we do the market risk premium. So we'll come back to this. So we'll put a mark there to come back. And then the third thing you can do is you can use the forward curve. This is my current approach. All right, so this third approach, I use the forward curve, and so the Treasury yield curve actually gives you a forecast of future interest rates. I think the ideal would be to compare the 15-year to the 5-year. I can't do that in this video because I can't go out and hunt for the 15 and 5-year. It's easy to get the 5-year, but it's really hard to find the 15-year Treasury. It's not a normal point on the curve. So what I'm going to do is actually compare the 20-year Treasury to the 10-year. And so in doing that, what I'm saying is, I'm asking, you know, right now the Fed is doing a lot of things. We got COVID. We come out of a financial crisis. Interest rates are unusually low. Let's get through this period. So over next, that's why I say 15 versus 5. Over the next 5 years and get to something more normal, I'm going to go out 10 years and say, what does the bond market say the 10-year Treasury yield will be in 10 years? And that's what the forward curve is doing. I have a video that you can use for that. I'm going to put this way off to the side. So there is a YouTube that shows you how to do that if you like. I'm going to do it today real quickly, so you'll just have to follow me real quickly, but it's fairly straightforward. So essentially we want to say where will interest rates be in the future, because right now they're unusually low. The 10-year Treasury really isn't a risk-free rate because you're not going to even make inflation. So what would the 10-year, what would the risk-free rate be in more normal times? Now, Damodaran argues to use the current 10-year Treasury because you can't buy the normalized Treasury. It doesn't exist anywhere. But you actually can't execute the forward curve. You could buy the 20-year Treasury and short the 10-year Treasury, and you would essentially have the 10-year Treasury 10 years from now. You'll end up with the exact same return. And so, you know, so it is possible to actually buy that bond in the future. And so what we want to do, I'm going to compare the 20-year to the 10-year. I would prefer to actually compare the 15-year to the 5-year, but I'll compare the 20 to the 10-year just because those are the numbers I can get. So I'm going to go into the internet, and you can just actually type H15. If you type H15, the first selection should be the Federal Reserve. If you're not sure, just do the Federal Reserve yield curves or yields. You can also just type the Treasury yield curve and it will come up. So it's only through to 26, so it's not going to quite match the number I just put up there for the current 10-year. But we want the 10-year and the 20-year. So the 10-year yield is 0.81%, and the 20-year is 1.37%. So I'm going to put those in as my data points. So the 10-year is 0.81%, and the 20-year is 1.37%. So what does the forward curve say? Well, what the forward curve is saying is, you as an investor, you could buy the 20-year Treasury today and you lock in 1.37% for 20 years. Or you could buy the 10-year Treasury today and then in 10 years buy another 10-year Treasury. When that one matures, you roll it over. And you should end up with the same expected return. You shouldn't end up with a lower return versus one. So what the Treasury market is telling you, if you buy a 10-year Treasury at 0.81%, when that time comes up, the 10-year Treasury is going to be much higher, and you can reinvest at a much higher yield, so that the first 10 years and the second 10 years will average out to 1.37. So here's the formula. You can watch the YouTubes to get this formula. It's a very simple formula. You take 1 plus the longer period of time, which is the 20-year, raise it to that period of time, which is the 20th. You divide that by 1 plus the shorter period of time, and raise that to the shorter period of time. So you start off with that, and we're going to take that entire thing and raise it to the 1 divided by 10, which is 20 minus 10, and then subtract 1, and we get 1.93. What does that mean? If we invest at 0.81% for 10 years, what would we have at the end of that? Plus 1 times 1 plus 0.81 raised to 10. At the end of 10 years, we'll have that. Then we're going to invest at 1.93% for the next 10 years. So we take that $1.08 that we had and we multiply that by 1 plus our 193, raised to the 10th. So at the end of 20 years, if the 10-year treasury actually is 1.93% in 10 years, then we'll end up with $1.31. Or we can invest at 1.37% for 20 years. Well, what would that give us? So you get 1 plus 1.37 raised to the 20th, and that gives you the exact same $1.31. So that 193 is what the bond market says they believe the 10-year treasury will be in 10 years. If they didn't believe that, then either the current 10-year treasury or the current 20-year treasury would be repriced so that it would reflect expectations. You might have had in your 3013 class, you talked about the different theories about the yield curve, and one of them was the expectations theory. So this is the expectations theory that we're taking advantage of, that the bond market actually tells us what people are expecting interest rates to be in the future. Now I know there's other theories, the liquidity preference theory, and inflation risk premium theory. There are some other theories, but right now you can execute that. You could buy the 20-year, short the 10-year, and you would lock in a 1.93% return for years 11 through 20. So there's that last approach. I'm going to use this last approach, 1.93. We'll come back to the normalized approach and see. So there it gives us our risk-free rate. So that should take you a few paragraphs to explain. Even if you just use the current treasury, you still got to talk about it. So the next one we'll do is the market risk premium. So the market risk premium, we are going to use the implied approach. So for the implied approach, what we're going to say is the required return on stocks should equal the expected return on stocks. We know that the market risk premium, I'm going to substitute MRP for that. We know that that equals the required return on stocks minus the risk-free rate. So we need the required return on stocks, but that doesn't exist anywhere. There's nowhere for us to go look that number up. And so what we have to do is we have to substitute an expected return on stocks, which is possible. The expected return on stocks equals the current dividend yield plus expected earnings growth. And you might add one other thing to this, and that's the buyback yield. We'll talk briefly about that. I actually encourage you to put the buyback yield in because it will give you much better valuations when you value this stock. So the expected return on stocks is the current dividend yield, maybe an adjustment for buybacks because firms are buying back more of their stocks now than they have in the past. And then you add that and expected earnings growth. We're going to say expected earnings growth is going to equal expected nominal GDP growth. Why nominal? Because inflation should be in there. We're going to say that expected nominal GDP growth should equal expected productivity growth plus expected labor growth plus expected inflation. And so we've got a chart for that. If we go back to our charts, we can see the historical numbers. The first chart just shows you that corporate earnings growth effect has actually been slower than the economy by quite a bit. The green line is how fast the economy grows. The red line is corporate earnings growth. And you can see there's a pretty big difference, but we're going to bring them back together there. And then the 10-year Treasury, you can see actually Damodaran has historically used the 10-year Treasury as his forecast of earnings growth. You can see that actually would have worked pretty well historically. The average 10-year Treasury is 5.72% and corporate earnings growth was 5.99. That has worked really, really well until now when we have such a low Treasury yield. So that's either that no longer works or the stock market is grotesquely overvalued. So we're not going to use that approach, but it does at least give some credence to that. And so what we're going to do with the second chart, we're going to snip that in to our analysis. And again, you'll be doing this in Word, so you'll be able to fancy this up quite a bit. So what we want to do is shrink this down some so we can see it. If you look over here, what you'll notice is especially productivity growth has been fairly stable over time. So we can say productivity growth expected. You can see historically, when you look at this, I'll go back to the bigger picture. You can see it's been 2 to 3%, 2%, 1.5%, 2.5%, 2.5%, less than 1. This last decade has just been abysmal. But the median's been 2%. So, you know, you could go probably as low as 1. I wouldn't recommend you go that low. You can go as low as 1 or go as high as 3. I wouldn't recommend you go that high. I'm going to split the difference and use 2.5% just because I think there are some productivity gains out there, but you got to come up with your own number and justify it. So slightly above historical median as many productive gains are out there. It could be autonomous vehicles, artificial intelligence, robotics, battery-powered cells. You know, we hear Tesla talking about a 1,000,000-mile battery life. Those are all huge when it comes to productivity. On labor growth, boy, it's come back here recently. This last decade, it was about a 1% growth, but that was after a decade where we had negative growth. We actually lost jobs over a decade. You can see the median has been about 1.5%, but boy, that's with the baby boomers retiring, that just seems ridiculous to me. I'm going to keep that a little conservative and go with 0.5%. Maybe you could go as high as 1%. And then inflation. There are a couple of ways to do inflation. If you watch my video, the YouTube videos, it shows you how you can forecast inflation using the Treasury curve. If you want to put that into your analysis, I'll definitely give you extra points for doing that. I really recommend that you do that. I'm just going to use 2% and just say I'm going to match the Federal Reserve target inflation. And so when I do that, I get expected nominal GDP growth. I just add those together. I get it about 5%. If you look at the actual historical numbers, it's averaged 6%, but that was in inflation. Well, really what I'm pulling off here more than anything is off of labor growth. So it's averaged 6%. I'm going to bring it down to 5%, mainly because I'm pulling off 1% from labor growth. The last 2 decades, a lot of the labor growth here is just coming out of the financial crisis. You average these last two decades, we're probably right at that 0.5% for the last 2 decades. The 70s, 60s and 70s, 80s, women were joining the workforce. We've had a lot of immigration, but now we have baby boomers retiring. So to me, it seems like it would be hard to maintain a 1% labor growth. So doing all of that, we've now got our expected nominal growth. Let's get the current dividend yield. And this is for the market. You lose a lot of points if you do this for your company. This is not for your company. This is for the market. So you can go to Yahoo Finance and get the yield for the SPY, because the SPY is the S&P 500 and an ETF, an exchange traded fund. So we can just go into Yahoo Finance and type SPY and bring this up, and the yield's really low right now. So if we look down at the yield, here's the current yield, 1.69%. So we've dropped back below 2%, 1.69%. So there's our dividend yield. What about buyback? So there's an article where Dr. Ibbotson and his team do an analysis of the buyback yield. And I don't want to go through that paper in detail. I've done it, in a couple of classes. You can definitely go see it. It's out there on Blackboard. You can read through it. But essentially, he thinks we should add about 1.5%. This is based on the Ibbotson article. I'll let you get away with just using that 1.5% and referencing the Ibbotson article. You'll get more points if you actually pull up the article and glance through it. It's highlighted, so you don't have to read the entire thing. Very, very interesting article. So what is our expected return on stocks? We would add the expected nominal growth in the economy, because that's going to match our earnings growth, the dividend yield, the buyback yield. We get 819. I'm going to round down, so I'm going to use 8%. On my 10-year treasury, I'm going to round down, and I'm going to use 1.9%. So what does that mean my market risk premium is? You take your expected return on stocks minus the risk-free rate, and we get a market risk premium of 6.1%. Anything in the 4 to 7% range is pretty normal right now. If you get above the 7, it just depends on what risk-free rate you're using. Expected return on stocks, I think 6% to 9% is probably rational. That you can probably get away with that. Anything below 6 is just probably a little too much. That's one of the reasons I want you to add in the 1.5% buyback yield, because otherwise stocks just don't value very well with a low number. Maybe the stock market really is grotesquely undervalued instead of overvalued. But I seriously doubt the stock market is expecting a return on stocks of just 6.5%. Just doesn't make sense to me. Obviously, we could have pushed up. On labor growth, you go 1%. That's only going to push this up to 5.5%. So that's not going to be a big deal for you. So, all right. So we're doing Walmart. So now we're going to get the beta. Now you notice, really critical. I'll come back to this normalized 10-year treasury, but you notice we have not referred to Walmart once. So you notice when I did the dividend yield, I did the dividend yield for the stock market. I did the buyback yield for the stock market. I did expected earnings growth for the stock market. None of that has to do with Walmart. So the same thing with beta. With beta, that's where you get specific to Walmart. But everything else up to this point is the overall star market. So let's do the normalized. So we're expecting economic growth of 5%. So you take 5% expected nominal GDP minus, let's do a 1.5% spread based on history. If you did that, you would get 0.05 minus 0.015. You get a 3.5% normalized treasury. Now, I used to do that. I have very uncomfortable doing that now because the 10-year treasury has been so far below 3%, really below 2%, now below 1% for a decade now. It's just been such a long time since we've had a 10-year Treasury higher than that. You can really see it in this graph. We fell below 4% back about a decade ago, fell below 3% about 5 years ago, and we're just staying down there. So, but anyway, so now I've got all my assumptions except for beta. Remember on beta, it's the process discussed in the notes, but the first thing you're going to do is you're going to define your company by looking at their revenue sensitivity. And then you're asking the question, is it a cyclical company or a defensive company? And there's definitely just subjectivity here, but here we're going to say Walmart is obviously a defensive company, has a discount store. People, Walmart did extremely well in 2008 during the financial crisis. They did extremely well during COVID. So they've proven themselves the last two major market sell-offs. They've actually done quite well. So it's a defensive company. So I'm going to come up under number one. I'm going to say beta below 1. In their discount store, and I would say in grocery. I think the grocery lends that as well. So this is a firm that's somewhat protected from the economic cycle. So below 1. How much below 1? We'll talk about that. I don't think it's, my range would be 0.6 to 0.9 maybe. Maybe not too much off of that. This range is going to be important when we do the last part of this analysis. The second thing you got to talk about is operating leverage. And here what you want to do is you want to talk subjectively. So we're going to say Walmart is hourly labor. So that reduces fixed costs. Remember, operating leverage is looking at the firm's fixed costs, how much fixed costs they have. So that implies lower beta. And then the other thing we can do is we can go to the Excel file. And the Excel file, if we look at the Excel file, so here's the Excel file. Let me put Walmart in there. So I'll do equal. You go to the paste values. Go find your ticker. They're alphabetical. There's Walmart. And so here, you definitely want to talk about the net margin. But the gross margin might be interesting as well. So let me bring these two in here. This says it's against the S&P 500. It's actually against the Russell 3000, but that's okay for our purposes. So I'm going to paste that down. We'll use this for both operating and financial leverage. Let me shrink it a little bit just so you can see it a little better. What we can say, Excel file shows very low standard deviation of margins. So what is that telling us? So we look at their margins. You can see the standard deviation. What this is a standard deviation of their margins. This is not their margins. I count off a lot of points if you say Walmart's gross margin is 1.21 or their net margin is 0.51. That's absolutely not true. This is the standard deviation of their margins. You can see their margins are much more stable, much more stable than the overall market. 1.21% versus 3.72, and 0.51 even more stable versus 6.3. They rank in the top 10% even higher. So very, very stable firm, just like you would expect. They're actually in the top 10% here and just barely outside the top 10% there. So very, very stable. So what is that telling us? So gross margin standard deviation to me is a measure of price elasticity of demand. Firms whose demand function is very sensitive to price changes, they will have a much more volatile gross margin standard deviation. Think about high price elasticity from your economics class. If a firm increases its prices 2%, its volumes fall 5 or 10%, that's high price elasticity. Raising prices would really harm the firm. Another firm has very low price elasticity. They raise their prices 2%, and the volumes don't fall very much. And they actually come out making more money, maybe cigarettes or alcohol or some places where I'm not sure how competitive those markets are, but the taxes that are put on top of those tend not to dissuade purchases too much. So very stable. But Walmart, very, very stable margins. Their customers are used to prices. If they're buying coffee, they're used to coffee prices going up if the cost of coffee inputs are going up. And then their net margin is even more stable. One of the most stable companies in the entire S&P 500. So very, very stable. So that suggests a lower beta. So beta in the lower end, maybe 0.6 to 0.75, somewhere in there. So that 0.9 really is looking way too high. And the last thing we do, we look at financial leverage. How much debt does the firm have? And you can see right here, debt to equity. Their debt to equity is slightly above the median for the industry. So that will push the beta up a little. So maybe our range here of maybe 0.65 to 0.8, who knows. We're definitely away from the 0.9. A little bit higher debt, maybe the 0.6 is, I think 0.6 is too low for Walmart anyway, but well, we could get down to 0.65 just because they've kind of proven themselves. And then the last thing is the history. Here's where we're going to do a rolling beta. We have videos on this, but I'm going to do it again. I'll do it on a separate page. So if you want to try to do this, you might want to try to do this for your firm as you're watching. And so I'm going to do Walmart, WMT. Let's see if I can actually get Walmart this time. And so here we have Walmart. I'm going to do historical prices. And when you get the historical prices, you want to click on the time period and just max it, whatever that is. And we want to do monthly. And so once we have that, we just download that into an Excel file. I'm going to take it, all of this, and copy it over to my file. I'm just going to do Walmart rolling beta. And all you need is the adjusted close. So you can get rid of every column except for the date and adjusted close. We can delete that. Now it starts 8/1/72. So I'm going to come back and click on the S&P 500 up here. And I'm going to do the same thing for the S&P 500. Go to historical data. But I only need to go back to August 72. And so I'll actually adjust that. I'm going to go one more month before that, so 07/31/1972. Again, do monthly and apply, and then download that. And again, we only need adjusted close, and really for S&P, you could just use the close. It's a price only index, so the adjusted close and close are the same. So I'm going to take that and copy it over. Come over to my file. Let me get rid of a couple of these. And paste in the market. So this is Walmart. And this is the S&P 500. So I've got my data. And I'm just going to check on the dates. What I usually do is I take out the first month because I don't know where that started. And then I'm going to take out the very, very last month because it's not October 31st yet. And so you can see my months are lined up. You might want to actually do a quick graph of your firm's prices to make sure there's no problems there. Sometimes there are data issues, and so you want to watch that real carefully. I've seen sometimes where they'll have a number Like right here, it's supposed to be 116.63, and they'll just put the decimal in the wrong place. Someone got fat fingers, and you'll see it look like that on your chart. You find that number, and you can just tell where the decimal should be, and just go in and fix it, and you'll see it. So I've only seen that happen a few times, but you might want to try that. Just graph your company. But once you have that, you can just take out the date for the S&P, because we don't need that because our dates are lined up. You might change the formatting so it's decimals. You might go out 3 decimals here just so you can tell, or even 4. And then what you're going to do is the holding period return. So we'll type holding period return. The formula for that is ending over beginning, or ending value minus beginning value divided by beginning value. So for Walmart, we take the ending value minus the beginning value divided by the beginning value. I'll put that formula over on the side just in case you weren't following me. We'll change it to a percent, and then we can copy that over to the S&P. So the S&P, same thing. Highlight those two and copy them down. And now you got your holding period returns for this whole period. All right, and then what we want to do is the rolling beta. And what we're going to do, here we only need Walmart. It's the only company we have. We can't, we have to have 2 pieces of data to do our beta against. So we want to go down 60 months, because that's 5 years. So you might just let Excel count for you, go down about maybe to row 63 or so. There it is, row 63 for mine. It might be row 62 for you. So find that. There's the 60th month, and in this, the beta formula is equal slope, and you do your company comma the S&P 500 close parentheses, and you get the beta for Walmart. Now Walmart's beta is really, really high here, so I've probably gone back far too much in history. Walmart was a much smaller company in the 70s, and smaller companies tend to have higher betas, so I don't really trust that. But I'm going to copy it down, and when I copy it down, I can go to the very, very, very bottom. You notice at the very bottom, the very last one is 0.27, beta 0.27. If I go back to Walmart on Yahoo Finance, the beta they show for Walmart on the summary page, go to the summary page, the beta they show should be real close to that last number. They're showing 0.28, I got 0.27, because they're doing the exact same thing we are. They're doing the last 5 years and monthly, and our very last number should be theirs. I think they're actually going into October, and that's maybe why they're 0.28 instead of 0.27. But anyway, so there's our rolling beta. Now what we want to do is do the median, the 10th percentile, and the 90th percentile. All right, let me put this formula up above so you can see it. So for the median, that's the 50th percentile. We'll do equal percentile. And we'll just highlight all of these betas, hit our F4 to lock in, comma, and go up and lock in that 0.5. So there's our median. Our median's kind of high. We can, if you lock in everything correctly, the only thing you need to lock in on the G62 is only the row. Only the row. You don't need to lock in the column. And so you can copy that over, and you can see the 50 percentile is 0.94. The 10 percentile is 0.27, which is where we are right now. Walmart is at its almost all-time low for its beta, and then its 90 percentile is 131. That's almost all this period here, and then you can copy that down. Then you just want to graph that, so Control Shift and highlight that whole section, insert a graph, and we want to give it a title, Walmart rolling beta. We're doing 5 years monthly, and we look for, you want to do select data. The one thing you do before you do select data is I would input a column right here and go up to the top of your dates, and just next to your dates just do equal year and click on that, and then change the format so that it is number, no decimal places, no common separator, and that gives you the year. You can just copy that down. So let's go find that graph. Here's our graph. So now we can put the years in there. Select data. So over here on the axis, go find that. There's your years. Title everything. Walmart rolling beta. The next one is the median. The next one is the 10th percentile. And then the last one is the 90th percentile. And so we're done. We got our graph, we got our chart. You might look at the spacing and see if that looks good. I might clean it up some. But I'm going to take this over and bring it to my historical discussion here. My history. History suggests beta at the lower range, especially history since when? Really probably since 2005. They just had a much lower beta since 2005. So that's gonna push me down to lower range of even 0.5 to maybe 0.7. So I'm in that lower range. It's definitely a defensive company, has very low operating leverage. Its debt is a little bit high, but not that particularly high. And its history has been very low, especially the last few years. Their beta has just, has actually been, the median of the last 7 years has essentially been their 10th percentile, right at that 0.27. 0.27 is way too low to use for Walmart. I wouldn't go that low. We've had 2 crises. You can see how the 2008 crisis and now the 2020 crisis have really definitely influenced that number. But that's where we go. So I'm going to use my final beta. The best way to do that, I think, in here is actually do a table. And you do revenue sensitivity, operating leverage, financial leverage, and history. So I'm going to say revenue sensitivity, I'm in the 0.6 to 0.9 range. Operating leverage, 0.6, maybe, yeah, I can't remember what I said up there. 6 to 0.75, 0.6 to 0.75. Financial leverage pushes that up a little bit, 0.65 to 0.8, I think is what I said. And then history gets you a little bit lower, 0.5 even to 0.7. Final beta, I'm going to use 0.7. And in my range, I'm going to do 0.5 to 0.9 just to really cover the entire range of my assumptions. But my base case will be 0.7. So there we've got our final answer. You'll have to just write all that up for your paper. All right, so now that we have our discount rate assumptions, let's actually get the actual discount rate here. So our discount rate will be our risk-free rate. We're using 0.019 there. Our market risk premium, we're using what, 6.1 there, I think, or was it 5 point? I can't remember. 6.1 there. And then our beta, this is the base case. Here we're going to use 0.7. And so our discount rate, will be the risk-free rate plus beta times the market risk premium. And so our discount rate for Walmart is 6.17%. You can definitely round that if you want to. 0.062% or 6.2%. So there's our final number. So now we're ready for step 2. So we've gotten everything we need for the first paper to get the discount rate for our company. We have some charts that we can use. You don't have to do all of these approaches. You need to pick one and explain it and talk about why you like it. So you will use the implied approach for the market risk premium, and for beta, the 4-step process has to be in there, and you have to build this rolling beta chart. So all those are required. So now what we're going to do is valuation. So we got the discount rate, now we need valuation. So for valuation, let's just look at all the inputs that we need. First, we need dividend 0. We need earnings per share 0. We need a long-term growth rate. We need a short-term growth rate. We need what's called H, which is the time from short-term to long-term. And we also need an inflation assumption. So that's all the things that we need. Let's get dividend 0. We can get that from Yahoo Finance. This is dividend 0 for Walmart. So here, beta is the first thing we did in the first paper related to Walmart. Here, everything's related to Walmart. So here, the dividend is actually Walmart's dividend. So how do we get a Walmart dividend? So I'm still in here in Walmart. So we'll go back to historical prices. And what we're going to do here, now if you go to the summary page, just let me show you, this is something that Yahoo Finance has kind of messed up. They talk about a forward dividend yield, dividend and dividend yield. This is not actually a forward dividend. You see forward dividend, you assume they're giving you an assumption for the next 4 quarters, but that's not really what it is. I'll show you what they're actually doing. So the better way to go is go to historical data and change it from prices to dividends only and apply. And they're rolling their last 12-month dividends. So you want the last 12 months is 0.54 plus 0.54 plus 0.54 plus 0.53. That forward dividend that Yahoo Finance is using, I think all they do is they take the 0.54, the last dividend, and they multiply by 4. I'm not sure exactly that's what they do. Let's see if they get 216 here. Yeah, 216. Now it looks like what they're doing now. I don't know what to do. Some firms that have very seasonal dividends. It might be 20 cents, 20 cents, 20 cents, and then 50 cents in the last quarter. I don't know exactly how they're doing that. So I don't like that number. So the best bet is get their actual dividend. And so we've got 0.54 times 3 plus 0.53. And so there's their dividend, $2.15 for the last 12 months. The earnings per share 0, that we can get from Yahoo Finance. The EPS at TTM means trailing 12 months, and that's $6.27. So that gives us our assumptions there. Long-term growth rate. So here again, Yahoo Finance, long-term growth rate. Most people tie this to their nominal GDP growth from the implied approach. It can be exactly that number. I'm going to say, well, with Walmart, I'm expecting the economy to grow 5%. So remember that 5%. Boy, I don't think Walmart will be growing as fast as the overall economy, because at some point they're going to get saturated, and throughout the entire world they're going to have a tough time just growing forever. And eventually they're just going to grow with population plus inflation. So population plus inflation, I'm going to say that's about 4%. Population growth about 1 to 2%, inflation 2% or so. Short-term growth rate, H, that will come back to that, the inflation. We want to tie that back to our inflation from the implied approach that we used up above. So we already got enough number for that, so there's no reason to do that again. Remember up above I used 2%, so I'll just use 2% again. So let's get the short-term growth. So as we talked in the notes and in class, there's 3 approaches. The first one is the PEG ratio approach. With the PEG ratio approach, we know that the PE ratio equals, the PEG ratio equals the PE ratio divided by expected growth, probably over the next 5 years. And so what we can do is, if we take, that gives us an expected growth will equal the PE ratio divided by the PEG ratio. And that will give us expected growth. So let's go for Walmart. Walmart's PEG. In Walmart, it's the forward PE, because that's what PEG is based on, not the trailing PE. So we go to Walmart, we can get this data pretty easily. Just go up to Walmart and just click on statistics, and it will be under statistics. So you look at the top, their forward PE is 25.71. That's their PE, not their PEG. And their PEG ratio is right here. PEG ratio, you say that's 5 years expected. And the footnote will tell you it's the forward PE divided by that. So this is what some analysts think, so 3.87. So that gives me an expected short-term growth of, take the PE divided by that. And you can divide it by 100 because it's not actually as a percent. And that gives me short-term growth of 664. That makes some sense, just how strong they're doing. The pandemic's still in place. That's a little higher than the long-term growth, but that makes some sense. So there's one. A second approach is to use what we call the sustainable growth formula. Pretty popular formula. And what it says is growth equals ROE times what we call retention. Retention is 1 minus the payout ratio. The payout ratio equals your dividends per share divided by your earnings per share. It's how much of their income, earnings per share, are they paying out in dividends. So let's go get Walmart ROE. We'll get Walmart payout ratio. So Walmart's ROE, very easy to pick that up. It's on the same historical statistical page. Come back here. It's under share statistic, I believe. Maybe not. Boy, they keep moving it. There it is. Return on equity. It's just right there. What I recommend, if you have more data, and I'll show you can get more data from Capital IQ. You have more data, you might do a normalized ROE. So this might be an inflated ROE for Walmart. So 22.9. So you might do the median of past 5 years or something like that. If, how do you spell median? So if the firm has an unusual numbers right now, especially if you have some pandemic numbers, you can get the ROE. I'll show you how you can do that from from Capital IQ. And then their payout ratio, you just look under stock, dividends, and all that, and they'll show your payout ratio is 34. I'm just going to say 34%. I'm just going to round it. So that means Walmart's retention is just going to be 1 minus that payout, or 66%. So their sustainable growth will just be ROE times retention, and that gives you 22.44, way too high. So I don't agree with that number. It's probably inflated some by some of the financial leverage, so I don't quite agree with that number. And the third one is we can just look at historical growth. And this, you can just get this from Capital IQ from the UTSA library. So I'll show you how you can do that. So here's the UTSA library. You just click on databases, go to C for capital. So let me get out of them so I load it from scratch. There's your Capital IQ. You got to log in to do that. They make you do it twice for some reason. I don't know why, but they let me in the first time here, but usually it takes 2 tries. I'm going to put my company up there, WMT, for Walmart. And all you got to do over on the side, you just find the income statement. And if you do the income statement, you can see down here they have earnings per share. Just go back a long time, go back as far as you can, or at least 20 years or so. And then bring it in, download this page. Now you got Walmart's data way, way, way back. We can copy all of this all the way back to 1979. I'm going to copy that to our spreadsheet. So there's my Walmart numbers. And boy, terrible colors here. Just make it all light green so you can see it. So put a title in here. So here we have their earnings per share right here. And so what you could do, you could just do the 10-year, the 5-year, and the 3-year growth. We call these CAGRs, compound annual growth rates. And so the 10-year, what you're going to do is do the last year divided by, and go back 11 years. Don't go back 10, go back 11 years, because you have to have a starting point. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Close parentheses, raise that to the 1 divided by 10 minus 1. And that shows you that their earnings per share growth the last 10 years has been 3.48%. Do the same thing with 5. So do the last year divided by, and go back 6 years. 1, 2, 3, 4, 5, 6. Raise that to the 1 divided by 3 minus 1. You can see much higher growth there because of COVID. And in 3 years, same thing. Current year divided by, go back 4 years. Raised it to 1 divided by 3 minus 1. Much, much higher growth because, again, COVID. So yeah, you just take the current year, divide it by, if you're doing 5 years, go back 6 years. If you're doing 3 years, go back 4 years, because you have to have that starting year to get your growth rate off of. And so there's our numbers. And so what I can do with Walmart is I can say their 10-year CAGR, their 5-year CAGR, and their 3-year CAGR. I can just go get those. So there's 10 years, there's 5 years, and there's 3 years, and that's probably why you can see how that number is really close to their sustainable growth, because it's so influenced by the historical numbers. So we're kind of all over the place in here, and this is not atypical at all. It's pretty common. So we got 3 approaches. We got the PEG ratio. It's giving us 6.64%. We've got the sustainable growth approach. That gives us 22.44. And then history. You know, recent, I'm going to take the 5-year. It's in the middle, but high growth rate. So my base case is I'm going to use 10%. I think Walmart has got some big advantages with the pandemic, but I'll use 10%. It's very subjective. There is no obvious answer for what this will be. It's your forecast, what you're going to use. Now this expected short term for the next 5 years, that's the average over the next 5 years. Our short term number is for next year, but then slowly coming down over time to our long term growth. So it's okay for our base case to be higher than what the market expects. First, we might disagree with the market, but also we might want to be higher because we're going to start higher and average down lower. So we've got all of our assumptions now. So our short term growth, we're going to use 10%. We got all of our assumptions except for one, and that's the H. How long would it take for Walmart to go from this 10% growth rate down to the long-term 4%? And I'm not going to make it, you know, just to warn you, 10 years is a long, long, long time. It's very hard for companies with high growth to sustain that more than 10 years. Walmart's a fairly stable firm, so I'm going to say 4 years to get from short-term to long-term growth, as the pandemic should end soon. And they don't really have many other prospects, and you know, it's going to end soon, and this is a mature company in a tough competitive environment. So if my time frame is 2 years, your H is 1/2 of that. So your H is 2. All right. So now we got all of our assumptions. So now what we're going to do is we're going to run our models. And there's 3 models we're going to do. The dividend discount model, the capitalized earnings model, and the H model. The dividend discount model, you can just use the formula. Capital earnings, you must explain. Sweet's theory here, it's in the notes. No one knows what capitalized earnings model means. That's just my creation. So, in fact, Darren hates this model. And the H model, you can just use the formula. So, dividend discount model. Remember here, we're going to take dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. For the capitalized earnings model, we're going to do exactly the same thing, except for instead of dividend 0, you use earnings per share 0, and instead of long-term growth, we're going to use inflation. But it looks exactly like the same formula. And then remember, for the H model, it looks again just like the dividend discount model, except for here, we're going to add a middle section to this, plus dividend 0 times H times short-term growth minus long-term growth, and all of that divided by KE minus long-term growth. All right, so let's try each of them. Dividend 0. We have our dividend 0 up here somewhere. There's our dividend 0, $2.15, times 1 plus long-term growth. There it is, 4%. Divided by our KE. There's our KE, 6.2, minus our long-term growth. I had some error somewhere. It matters. So there's my price there. I can now do that exact same model now, but now with earnings. So I'll take earnings per share 0 times 1 plus my inflation rate divided by my KE minus my inflation rate. So yeah, I actually hit the H instead of inflation rate, but inflation rate. And there we have 152. What I like about this model is, I think one thing with Walmart is I don't think their dividends really reflect their true free cash flow, so I think it understates what they're worth. I actually think in this case capitalized earnings works pretty well because I think Walmart's a very mature company. So I like that model. Now let's try the last one, the H model. So we take dividend 0 times 1 plus long-term growth plus dividend 0 times H times short-term growth minus long-term growth, and all of that divided by KE minus long-term growth. We get 113, and we can check this. If you take this formula and bring it down, we know that the difference between the dividend discount model and H model is just this middle section here. So if you just leave that middle section all by itself, that difference should be the difference in the two models. So if you take the H model minus that difference, you should get the dividend discount model, and sure enough, we do. So there's our solutions. Now the last thing we want to do is sensitivity. I'm going to show you that in the next video, so I'm going to stop it here and I'll show you that in the next video. But so you definitely want to do this in your paper, but I don't want this video to get too long, so we'll stop it there. Now we're going to move on to the sensitivity analysis, and so let's look at our assumptions for Walmart. So let's put them all back together in one place so we can somewhat understand where we're going to go with the sensitivity analysis. So we decided that our market risk premium and our risk-free rate, we've got those decided. So we decided the risk-free rate was, I think, 1.9%. So our risk-free rate is 1.9%. Let's just print it all down here. And we decided our market risk premium is 6.1%. And so those are the basic assumptions that we will not change. We'll use those for everybody. And then we said on beta, we have a base case. We wanted our base case to be 0.7. That makes a lot of sense for a firm like Walmart, 0.7. And we said our range would be a low to a high. So we said the range would be 0.5 to 0.9. So 0.5 would be the low, 0.9 would be the high. So there's our beta cases. And then let's look at long-term growth. And here we have a base case. So our base case for growth was 4%. So let's think about a range on that. Keep hitting the cap lock. So let's have a low of, boy, on this one, I don't know how low we go with Walmart. Let's say 1%. And a high, boy, Maybe, boy, we looked at the data before. Remember when we looked at their range of growth? So their 10-year was 3.48, 5-year is pretty strong, and the 3-year is pretty strong, but that's more of a short-term growth rate. This is a long-term growth rate. We can't definitely grow that fast. I think 5.5 is about the best we can go there. When you do your own company, obviously you can come with your own ranges. One thing to remember though is we'll get our discount rate. Our base case discount rate is the risk-free rate plus beta times the market risk premium, or 6.2%. And so with that 6.2, we don't want our highest growth rate be close to that number. We don't want to be like 6.1% or something. That's just too high. So we want to make sure we have a range of growth that's going to be below our discount rates. Now we'll probably get in some problem here at the bottom, and you'll see. So what we're going to do down here is we're going to set up the base case. So we're going to do the dividend discount models. So remember that the dividend discount model is dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. So we need to have dividend 0 So dividend 0, we got that early on somewhere. I have to go back and find it. Here it is. Dividend 0 is $2.15. So there's our dividend. So we're going to find a cell. I'm going to put it right here in C129 where we're going to put that formula. So equal dividend 0 times 1 plus our base case, we're doing everything base case, 4%, divided by, so our KE is going to be our risk-free rate plus beta times the market risk premium minus our long-term growth. And we do that, we get 103.04. Remember our previous model is 101, and the reason it is because we used 6.2 as our discount rate. We rounded it. If we hadn't have rounded it, we would get the same answer. So I can just show you here. If we hadn't rounded, we get 103.04, 103.04. So remember, we rounded our discount rate. So you might not want to round your discount rate. I'm going to leave it. I'm going to go ahead and leave it here just so I know my base case matches the number I got. So there's a good reason not to round that discount rate. So 103.04. So now what we're going to do is we're going to look at our betas. So we want to do our range around betas. Here you want to make sure you start with the highest number and go down to the lowest. So we'll start at 0.9 and we'll go down to 0.5. So there's our betas. And here we want to do our growth rate. So we'll start at our low, 1%. And we'll raise that 0.5% all the way up to our high, which is 5.5%. And then what we're going to do is we're going to change these numbers so that we can run scenarios. So what you want to do is you want to highlight this entire area and then do data, what if analysis, data tables. So data, what if analysis, data table. And your input cell is your beta, so your base case beta is there. So your row input, because we have beta across the row, so we want to say that that's 0.7. Instead of all of these numbers, it's going to be 0.7. And then our column input is the growth, so we go to our base case growth right there. So you reference for your row input, you reference your beta. For your column input, you reference your base case growth, and you say OK, and we'll give you a bunch of data, so we're going to convert that to commas. Now I'm going to clean it up here and just make it look pretty good. So we're going to change that to blue. Just make it look good because you're going to put it in your paper. And here's our growth numbers. And what I like to do on here, so let's just find that base case. And here it is right here, 4% growth, 0.7 beta, 103.04. So that looks good. So we don't really need this number. What we want to do is we can just hide it by just making the cell and the text the same color. So that doesn't show up. So now we got all these prices. Now what do we want to do? Well, let's go get the current price for Walmart. And so we can see the current price of Walmart is $137.98. $137.98. So we'll put the current price in there. And so now what do you want to do? Well, here's our valuations. So there's a few things we want to do here. First of all, if we have a negative number, that doesn't work. What that means is our discount rate is lower than our growth rate when we get into low betas. And so the first thing we want to do is hide those. So what we're going to do is we're going to click on this and we're going to go to conditional formatting. So for the times when the stock price is greater than the current value, when it's greater than this, we want to make it green with green text because that's good. So like here, we think the stock's worth 143.11. It's trading for 137. So that's good. We like that. So we'll say OK. We'll do another conditional formatting when it's less than the current price. That's when we want red. And then the last one we want to do conditional formatting. If it's less than 0, here we want to do a custom format where we want to use a fill that is black. We just want to completely black it out. And let me change that. You want a fill that is black, and we want the text to be black. So you just want to black those out. So it didn't do it. So our font is black, and our fill is black. We say OK, and that gets rid of those. So those that are negative don't make sense. And so here we have a chart for Walmart. Now what you want to do is say, well, where's my kind of my normal range? So 0.7 is it, and maybe I think 3.5 to 4. So I think this is probably my best area. Maybe it's a little higher than that. Maybe I'll go like this, or maybe I'll go like this. So I'll do a thick border. Maybe I'll bold those. So maybe this is really where I think my valuation is, but I got full valuations. Here I'm going to, based on this, I'm going to recommend avoid or sell Walmart as valuation as it appears overvalued. Because you can look and tell from the chart that in my main area that I think the valuation is, they're only cheap in one cell. That's with a beta as low as 0.65 and growth of 4.5%. But most of the table is pink and doesn't really doesn't tell you the story for strong story for Walmart. They could be worth as little as $50, $60, $69, and they're trading for $137. Now, you might not like these rows, so you might say, hey, you're way too conservative. Make sure you check on the boxes. So you might make sure the column width is exactly the same all the way throughout. That was too much. So just make it look as professional as possible. And so yeah, even with the higher growth going to 6.5, you can notice with the 6.5% growth, you have a lot more of these infinite values that just get kicked out. So here it's maybe a better case, but boy, Walmart is struggling. I really have a hard time believing Walmart's going to have consistent 5.5% growth for the next 30, 40, 50, 60 years. That's much faster than the economy. You know, I think the economy is going to grow 4 to 5%. I just don't think Walmart is a firm that's going to grow faster than the economy. They're so saturated in the markets they're in. They're really struggling growing overseas. And there's some pretty hefty competition. Obviously Amazon and Alibaba and firms that are just really good competitors. So I would probably recommend for this firm, avoid. So this is a chart you should put into your paper. It's a really good chart. What it does is it allows you to go beyond just one price. So up here you had one value for discount model, and then you had other valuations. And so, yeah, that's fine. Overall, Walmart looked expensive on a dividend discount model, H model. They looked a little cheap on the capitalized earnings model. However, when I ran multiple scenarios on the dividend discount model, I got a valuation that made Walmart look pretty expensive. Now, for the H model, is there a way for us to do this with the H model? And you don't really need the data table from Excel. You can essentially build your own data table. So let me show you what I did with the H model. So I'm not using data table, I'm building my own. So up here I have the risk-free rate. And so I just have that across, and I'm not doing any scenario analysis on that. It's just 1.9% all across. Here I got the market risk premium. Here I got my beta, so that I do adjust. And here I have my long-term growth. 4%, my base case. And so if you look at the 0.7 and 4%, you get my 103.04, so that works. And so what this is right here is, this is my denominator. So if you think about it, if you think about the denominator, let me widen out these cells a little bit so it's a little easier to see. So for my denominator, I still can get the whole word in there, but what is my denominator? Well, here's my discount rate, my KE, and there's my long-term growth. So the denominator is just the discount rate minus the long-term growth. So that goes all the way across. It should go from higher to lower. And then over here, what I did is I've got my dividend. That doesn't change. Here's my long-term growth, 4%. And here's my short-term growth. I'm running scenarios there. And here's my H. I'm running scenarios there. And so essentially, this is my numerator coming down. So remember there, I just take dividend times 1 plus the long-term growth plus dividend times the H times short-term growth minus long-term growth, and that gives me my numerator this way. And so here I'm going to create my own data table. So I'm just going to take the numerator G21 divided by the denominator H20, and I'll lock in the column and I'll lock in the row, and then when I copy that wherever I go, I'm just taking that, and here's my valuations. So just like I did before, I've got my valuations, and so I can, again, now here, what you probably want to reflect is the short-term growth and the H. So you probably want to take this cell and move it off to the side. And so you've got that, and here all you need is beta here. So let's move this down, and let's just bring our beta down here. And so now you've got beta going across, and you have growth long-term, growth short-term, and you got your H. Let me do it like this: growth long-term, growth short-term, and you got your H. So you can adjust that just by click and do format cells and do subscript. And here you can adjust that, format cells and subscript. Your H, and then you have beta going across. And so here we have our own data table we built ourselves. And so I can do the same thing here with the conditional formatting. Here I don't have, because I'm only using the 4% short-term and long-term growth, I don't have any negative numbers. So I can again do conditional formatting. If it's greater than my current price, then I want it green. And if it's less than my current price, I want it red. And then if it's less than 0, I want to make it, no, I don't have that in this case, but I want the field to be black. I want the font to be black. We don't have that issue. And so there's my model. And so here, let me just show you how you can clean it up. You're probably going to have to add some rows, but here, this is beta. So I'm going to do Alt-HMC to center that and put the word beta with white text and bold. And here I've got my long-term growth, short-term growth, and H. So here's my, maybe we can move this up. So here's all my assumptions, just clean it up, however it makes sense to clean it up. And now you've got the H model with valuations. It looks a little bizarre, but I think it works. And again, you can just highlight an area you think is your normal range. And again, I would not be, well, I have a little stronger case here for Walmart. I can get a little bit more. It kind of makes sense for them to have high growth given what's going on with COVID. I don't know if an H of 3 makes sense. That's pretty long. A 5 definitely doesn't make sense. So some of these I just don't believe. So it gets a little bit, so you have to come with your own assumptions. So the assumptions are still pretty powerful. But if you look at this, if you just copied and pasted that into your paper, you have a strong sensitivity analysis to use for your company. So try it out. At least do this table with the dividend discount model, but see if you can do something with the other models like the H model and create some sensitivity analysis. And when you look at the student example papers, you'll see some examples of how they do these data tables.